Markets in turmoil. Is this good news or bad news? Are you leaning into the volatility or are you afraid of it? Well, we're going to talk about that. I have a return guest, Mr. Lior Gantz from Wealth Research Group. He's going to let me and you know how he's reacting to the markets and the NASDAQ and other sectors melting down. Where are the pockets of value? How can you potentially profit from this? So, Mr. Gantz, welcome back to Looking at the Markets, sir.
Thank you for having me.
Yeah, it's great. Your watch lists have killed it. I mean, just made amazing returns in the past. What I'll do is I'll put a link in the description below this video to some reports that people can download, and you can tell us about that and what you're looking at right now. So the NASDAQ absolutely melting down and bringing other stocks with it. Is this the beginning of something much worse? What do you think?
I think let's understand what's going on with Russia and the Ukraine. Mm-hmm. Those two regions that are in question, the ones that are pro-Russian and they've declared their independence and sovereignty, and Putin is, trying to stoke the flames and say yes, they should be independent, they deserve sovereignty and whatnot. These are very agricultural-like regions in the Ukraine. They're scarcely populated. It's not a gem. It's not like coveted real estate, and it's not what this is all about. It's to Putin, that region is part of a bigger chess match, and it's actually part of an even bigger chess game that's going on a global scale. So for like a month or almost 2 months now, Putin has been sending troops, 100,000 troops, tanks, missiles, cannons, everything, blood transfusions, medical staff to the border of the Ukraine. And his idea is that he considers that area as part of Mother Russia, and he wants it back, very similar to how Germany looked at Eastern Europe after World War I, where they said, look, Austria is ours. Not that I'm comparing, obviously, Putin with that leader. I'm creating a similarity between what happened then in Europe and what's happening right now. Obviously, we had the fall of the Soviet Union, and a lot of territory became independent, and some of it they still considered their own, just like China considered Taiwan and Hong Kong their own. What's happening is that Putin wants to make sure that the Ukraine doesn't join NATO. NATO is an army that was created when the West fought the Soviet Union during the Cold War, and that was their way to defend. During the 60s, if you remember, they put missiles in Italy and Turkey and got closer and closer to Moscow, and that's what prompted Khrushchev at the time, the Soviet leader, to say, well, if you're going to put nuclear missiles in striking distance of Moscow, then I'm going to do the same to you. And via submarines, they shipped nuclear warheads and all the infrastructure to Cuba, and almost resulted in World War III. So the similar situation is happening today, where the Ukraine wants to join NATO. If that happens, they join the West. Russia and the Ukraine have a 2,000 kilometer border. And if they put missile systems across that border, a missile from there to Moscow is a 5-minute cruise. So that cannot happen. And for Putin, what he's trying to do is he's trying to flex his muscles enough so that by diplomacy, the West will basically realize that they cannot include the Ukraine in NATO. At the same time, Ukraine is a sovereign country and it can make their own decisions. So it's a big deal. And you add a few more layers to it. 40% of the heating for all of Europe for the winter comes from natural gas from Russia. So there's pipelines involved in heating and a lot of other considerations to keep in mind. in general, Putin can care less about those territories. It's not what he's after. What he's after is changing the world order, making sure that he wins and that he shows America that they are losing in the standoff between Russia and the United States, which is going to be huge. And so, from the bigger picture, you got China looking at all of this, and they're saying to themselves, okay, America failed in Iraq. They fled Afghanistan. They left all this equipment behind, all this mess behind them. They're obviously hating war. Just like the British hated war after World War I and did not want any conflict. Their prime minister back then, Chamberlain, was ready to concede on anything that seemed reasonable to the Germans because the British just did not want war. So when Germany wanted Austria, they took it. When they wanted the Sudets, they took it. When they wanted that part of France, Alsace-Lorraine, they took it. And basically only when they invaded Poland was that like the last straw. And even then, history lovers would know that the British and the French in September 1st, when they started to mobilize troops, they told the troops that they would be home for Christmas. This is Christmas of 1939. Some of them were recruited without weapon. They were just recruited because they thought it would be an easy and quick conflict. No one knew the real extent of what's going on. So is this dangerous? It is dangerous from the standpoint of what happens here is going to reflect on how China behaves with Taiwan. Because if Russia can invade the Ukraine, then China is going to assume that they can take Taiwan. And that's a big deal. That's the biggest geopolitical threat to the world right now. Because if China and Taiwan get into a conflict, Australia and the U.S. will join NATO. It's the beginning of a huge issue. And that's what really is frightening the markets. Mismanagement of this conflict that in and of itself means not much to the global economy. If there are troops entering those two regions of the Ukraine, it doesn't really register as part of global GDP or anything like that. It's the big picture that's important here. What this means for China, what this means for the world order, what this means for America's stance as the superpower of the world that can dictate terms. And that's really what this is about. So when you look at what's happening with global markets, it's a reflection of the bigger fear. Is this going to be like the Bay of Pigs? Is this going to be problematic to a global extent? Is this going to send us into a spiral? And that's what I think people are really thinking about, or algorithms and big money is really thinking about, if that answers your question.
Absolutely. Now, what I'm wondering is, will this be a perfect excuse for Jerome Powell and the Fed not to act in March and just going forward? What do you think?
So the one thing, and that's a great question. The one thing that is nice about being behind the curve, and that's obviously what the Fed is. They're behind the curve in terms of interest rates and balance sheet, etc. Because for a full year in 2021, Jerome Powell kept saying that inflation is transitory. The real reason he was saying that inflation is transitory is, there's two reasons he said it was transitory. One, he really had an opinion, as did many people around the world, that inflation is transitory, and that when the economy starts to reopen, ports will loosen up, all these delays in ships and shipments, truckers, logistics, those will go away. And obviously, if we open up, then you won't have 4 billion people just buying appliances and apparel and a lot of goods. They will go back to a balance between goods and services. Obviously, when you're home, you can't go to the hair salon and to nails and masseuse and get a lot of the services that the Western world goes to because you're quarantined or self-isolated, etc. And so, because of Delta, in August of 2021, this whole transitory thing, it became a big problem. Secondly, it was just the administration didn't perform. They didn't relax regulations on ports. They didn't do anything to legislate new laws regarding chip shortages and priority for car manufacturers, etc. They failed. The administration failed in regards to how to handle incoming supplies, while demand for goods was unbelievable. And so you had those two dynamics. The Fed thinking, okay, well, we live in a very robust economy. Obviously, supply chains will be sorted out by the free markets. Therefore, inflation is transitory, not considering that there's going to be another wave in September of the Delta. And obviously, because China has a zero COVID policy, they shut down everything, causing more delays. And then because companies saw that this is not working, this just in time, they started buying Christmas of 2021 goods in June. So you're creating even more problems, even more warehouse shortages, even more port congestions, and then you had the Suez Canal and everything like that. So I think the Fed thought that it was transitory. In August and in September with the Delta, they realized it's going to be transitory for longer. But in November, when Biden and Powell met behind closed doors, he told them, look, if you want me to reconfirm you, this is, I'm obviously speculating, but this is definitely the vibe. If you want me to reconfirm you, you can't keep saying that it's transitory for longer. You have to change stance because Americans are seeing inflation, and I'm losing lots of credibility. My popularity is plunging. And so the day after the meeting, he said inflation is, we should retire the word transitory. If you look at that date where he said that, it was November 5th, and a day later, the NASDAQ peaked, November 6th. That's it. Never came back to those levels. That was the all-time high. The S&P 500 peaked about a week later. And so this U-turn from the Fed really caught the markets off guard, because the markets realized, inflation is much more entrenched than we thought. It's trickling into wages, the rents. It's going to stay with us longer. The Build Back Better plan, when it failed, it showed that the Democratic Party doesn't have the right kind of power, capital power in politics to relax mandates, to help the ports, to hire work, to do all the things that are needed. We have a shortage of 400,000 warehouse workers, like forklifters and all that kind of stuff. We have, I think, between 15 and 40,000 jobs missing at the ports. So, you're talking about things that will not get solved easily. And therefore, inflation is here with us. The thing that's nice about being behind the curve then, because the Fed is obviously behind the curve, is that they can see what the markets want them to do. They can see what the markets like and what they don't like. Because when the markets don't like something, you see it in equities, you see it in bonds. And so it's almost like, think about it in terms of, being a Formula One driver ahead, and there's one behind you. It's nice to be behind. You can catch the draft. Plus, you can see what the leader is doing. You can pass them. You know how to. You have that better chance. And that's what the Fed has. They know what the bonds market is thinking, and the bond market is giving them the green light to raise rates in March, and so they will. At the time of this interview, it's giving them a 68% chance of doing a 50 basis point rate hike, something that hasn't been done since the year 2000 with Greenspan. I don't think they'll do it because of what's happening right now with markets and everything. But they may do it. The thing is, raising interest rates, it does influence inflation, but inflation is supply and demand. Supply is amazing right now, like it's insane. Demand is insane. Americans are buying a lot of goods, and when we start to reopen, they'll go back to services and ease some of that demand for goods that's creating all this inflation. But the supply side is a problem. You have 2,000 ports in America, but 40% of the imports come from two main ports, Long Beach and Los Angeles. Those are the ones that are really filling the burn. You have ships that are parking there for 9 days. That's unheard of. Usually ships, they go in and in a matter of hours they leave, and the shipment is taking out of the port by a matter of 2 days. Now you have, I think, about 35 to 40% of all shipments, they get stuck in the port for 8 days or more. So you're not living in normal times. And I think that's going to take more to play out. So even if you raise interest rates by a little bit and maybe, tame down the real estate market, maybe tame down some corporate, borrowing, that's not the real problem. The real problem is the supply side, the logistics, and that's not going to get solved that easily. So even if the Fed raises rates, I think inflation will stay a little bit elevated. So 5 or 6 or 6.5% on the CPI, and obviously we all know that the CPI doesn't count in energy and food and rent, so it's obviously higher. In general, I think that the markets want the Fed to raise rates. And so come March 15th, once the Fed raises rates, I think that's a positive for the markets. The markets are actually going to like it. I don't know if we rally, but we certainly alleviate a lot of the fears that are happening right now with regards to inflation. So I think they raise in March, they raise in June again. And by that time, we'll obviously know about Russia and the Ukraine by then. Inflation will print. We'll have the March CPI, the April CPI, the May CPI. So we'll know the trend. We'll see what's happening with this Great Resignation, because about 40% of American workforce has changed jobs in the past 2 years. That's insane. And so we'll see if they go back to work. The Biden administration's whole theory was everyone will get vaccinated, everyone will feel safe, everyone will go back to normal. That's not happening. A lot of people are recalibrating their lives. It's amazing to see it. They're willing to just wait. When you choose a career, you're not open to other things, and people are just waiting it out. They're waiting for better offers to come along. We're seeing a lot of hybrid workplace. So this, 9 to 5 go to the office. I think that's almost gone. It's going to be gone in the Western world. You're going to see way more people doing hybrid jobs where they go to the office when they need to. But I mean, if you go to the office at 9 a.m. and you have 7 Zoom meetings and you go back home, I mean, you can do that from home. So there's a lot of that going on. We have gone through a 2-year period that was a reset in many regards. No one, if you'd asked all the people in the world, would they volunteer to go through this massive stress test for corporations, for governments, for individuals? Would you be able to stay at home? And if you told all these people in advance, the entire population of the world, that they need to go through this stress test, nobody would volunteer for this. But we have gone through so much, and so many efficiencies have come out of it. We're in a very good spot right now in general for the American economy. And I think that as we move into the second half of the year with the midterms, a lot of promises are going to be made from political, from both sides of the aisle. Inflation will be trending down because we're going to reopen, and obviously that's going to help workers to go back, and obviously less stimulus will also help people go back to normal. So I think that's going to happen. Raising interest rates is obviously what the markets want, so that's good. And the other risks that are factored in right now, there's a risk of recession that people are talking about. So, in the real world, when I look at traffic in malls, and I look at traffic on main streets, and I look at what's happening in the United States, I mean, I just don't see it. We have, it's a very strong economy in the United States right now. The demographics look amazing. Real estate, even though it's unsustainable, what's happening, fundamentally speaking, there's a shortage of about 3 million homes. And you're entering a period where, for millennials, apartments used to be a place to crash at the end of a busy day. Like you leave the house at like 7 a.m., come back at 9, and that's your apartment. Now people live at the house, and more millennials are getting married. So I think real estate is going to be a great industry for a while. There's a big shortage of homes, and there's a lot of demand for homes across America. So if you haven't gotten into the real estate industry, part time or full time, whatever you do, if your income is not enough right now, you should find a way to get into real estate, like getting a real estate license, an agent license, getting involved in finding and locating bargain homes and etc. Just get into the industry whatever way you can as an investor, as a mentee of a mentor, where you can work for sweat equity. There's so much opportunity out there right now for real estate. So that's with regards to how I see this whole thing. The Fed is not in a bad spot. The expectations from the Fed are horrendous. Everybody thinks they're going to screw it up. So it's very, they're in a good spot in terms of, it's hard for them to disappoint. They're at the bottom of popularity with this insider trading ordeal. They're at the bottom of popularity with their credibility. And they're also sending mixed signals, right? You got Ballard saying, I want, 4 interest rate hikes or 1% by June. And you have Jamie Dimon and the Wall Street and Goldman Sachs and Wall Street factoring in like 5 to 7 rate hikes, where Powell just said 2 or 3. And so this mass confusion that's going on, it's very hard for the Fed to disappoint because any clarity from them is going to be deemed as a blessing. I think the one last thing to keep in mind, David, is that we've had 6 rate hike cycles since 1971, where the Fed says, hey, we're going to start raising rates. Twice in the 70s, we had one in the 90s, we had 2 in the 2000s, and one from 2015 till January 2019 or December 2018 when they U-turned. Right. So every time in each of these times, gold has rallied. That's an interesting fact to keep in mind. 100% of the time, 6 out of 6, gold has rallied. The average gain, 30%. So if you take 1900 where we are today, and we're just 3 weeks away from a rate hike, 30% of 1900 is $570. Plus 1900, you get to nearly 2500 for gold. And the market is already pricing in a rate cut in 2024. So if we're going to see a 30% move for gold in the next year and a half, I think that's, and obviously way above the all-time high at the 2,067 an ounce from August 2020. I mean, that's incredibly bullish for gold. For that to happen, what I'd like to see, like confirming indicators, for one, I want to see silver rising above 25. It's right there, but we need to see it. Then we need to see it breaking above 29. So just hear me out. Silver, to me, is the leading indicator right now, not gold. I want to see silver moving first, moving to 25 and then 29, which is where the real resistance is. And I want to see it breaching above that 29. That, to me, is going to create a very high reward, low risk scenario, because those are very confirming indicators. The third one, that's going to be the most incredible confirming indicator, is you want to see the DXY, which is the dollar index versus a basket of other leading fiat currencies. You want to see it go below 90. It's currently 96, so that's a big move for it. If you see those three things, I think you're at the you get a very high conviction move in anything related to commodities and mining.
Interesting. 30% average move in gold during rate hike cycles. This is something I will remember and will report on again. I want people to check out the reports. Links are in the description below this video. Go ahead and download them right now. Why not? wealthresearchgroup.com/2022 can help you get that roadmap that you need for the rest of this year. Also, wealthresearchgroup.com/ watch list. The watch lists that you have given me have absolutely killed it in the markets, done amazingly well, double-digit gains, and sometimes more in certain asset classes. Very amazing. People are going to have to download the /watch list to get the whole thing, of course, but where are some pockets of value that you see now that the markets have corrected?
Yeah. So the markets are relatively in a great spot. If you look at the S&P 600, so the small caps, they're trading at and the mid caps, the S&P 400, they're trading at their lowest valuations since 2011. So the mid caps and small caps, so companies between $1 billion and let's say between 10 and 15 billion, which comprise a lot of the market. The S&P 500 is comprised of a lot of multinationals, but the Russell 2000, the S&P 600, the S&P 400, those are mid-cap to small-cap companies. These are domestic companies, American companies. Those are trading extremely cheap compared to the last decade. Now, obviously, if you compare them to all time, you need to adjust that for interest rates. And if you do that, they're still cheap because we have zero interest rates. So I like that. Equities are cheap. If you look at the other alternatives like real estate and bonds, I mean, bonds are the biggest bubble on the planet. I'm not counting like pictures of monkeys on JPEGs. I'm talking about like real established asset classes that real people buy.
Right.
Bonds, sovereign bonds, it's a bubble. So unless you're mandated, unless you're a big institution, a pension fund, an insurance company, and you have to have a component of bonds in your portfolio, as an individual, I would stay clear. So then that leaves you with either equities, fixed income debt. So lending money to real estate, against real estate collateral, etc. I mean, I lend against real estate collateral, and that makes about 10%. So if inflation is about 7 to 10%, I mean, nominally, you're just breaking even. So I think equities offer the best risk reward right now, unless you get into real estate and you know what you're doing and make it more of a business for yourself. But for passive income, for long-term investors with a 5, 7, 10, 15, 20, 30-year outlook, like myself, I'm going to be 38 in the summer. I mean, for me, equities are right now in a very good situation. Even if you look at the large caps, and even if you look at the mega caps, I mean, the markets have given up almost a year worth of appreciation. In some cases, they've given up 2 years worth of appreciation. And it's not only that, David. Some of these companies have survived, adjusted, tweaked, and made efficiencies in the last 2 years that are amazing. They're reporting amazing earnings. Their cash flow is better than ever. Their growth prospects are better than they've ever been. And so apart from a lot of panic that's happening right now, if you look at the big picture, there's a lot of value to be had in several industries, and certainly in many stocks. I have published our top 10 for Wealth Research Group this year. So if you subscribe to our free newsletter or will become a subscriber to our newsletter following this interview, we will be keeping on reporting regarding these companies. So I see companies that have triple-digit potential just in 22 alone. There are some companies that are really in the distressed valuations. The thing that happened is because so many companies IPO'd in 2021 into this massive sell-off in mid-caps and small caps, Wall Street or institutional money has not gotten in and built this. If you look at large companies in the S&P 500, and you look at the the holders, like who are the major holders of these companies, it's usually BlackRock, Vanguard. There's like 60 to 70% institutional money that's never leaving the stock. Never. They're just going to keep buying. That's what they do. They're institutional investors. So it means that they either hold or buy more. But man, there are probably 30, 40 companies that have gone public. Their prices declined by over 50%, 50, 60, 70%. The companies are beating on top line. They're beating on the bottom line. They're beating on EPS, and they're guiding amazing. And they just can't find a bottom. So if you look at those types of opportunities, they're incredible. To me, I think that in the next 3-4 months here, the market will continue being treacherous, and it's not going to rally by much. It's just going to be a lot of wait and see, because everyone wants to see how interest rates will impact everything. So a lot of accumulation of shares can be done here, where in a year or two, you'll be happy that you did so. But the one thing that can run away from you right now are the mining equities. That's where if gold just makes another big move, so let's say it has a $20 or $30 day, it's going to attract a lot of new money. And I think if silver makes a big move here, so from 24, where it is right now, to 26, 27, 28, and you know that those happen fast with silver. I think we're going to see a lot of money flooding into the mining equities. And as you know, it's a very small sector, a lot of money chasing it. You will see triple digit gains in a lot of the mining companies if that happens. So I think that's the one sector that can run away from you if you're not going to take a position soon.
Yeah, I have always believed in not only owning the bullion, gold and silver, but also the mining shares can give you amazing leverage. And these are stocks you can buy in most self-directed brokerage accounts nowadays. I do recommend people download wealthresearchgroup.com/2022 for a roadmap for the rest of this year, and also / watch list. Get those and study them. Amazing stuff. And finally, I just wanted to take you to task a little bit here. I remember a while back you recommended or suggested that when the S&P 500's dividend yield is higher than bond yields, that's bullish for the S&P 500. That might be reversing now, though. So is that a caution signal now that bond yields might actually go higher than the S&P 500's dividend yield, which is about 1.3% annualized? What do you think of that?
Absolutely. That's the reason that right now the markets are selling off. A lot of institutional buyers that were holding on to S&P because of the dividend yield being higher than the 10-year bond are ditching and moving to bonds. Because the 10-year bond is about 1.9 as we're doing this interview. So it's way higher, making stocks a lot less attractive for fixed income. So what needs to happen is basically, I guess, your question. Well, either the S&P 500 corrects a lot more, and that's going to raise the dividend yield, or bond yields need to start coming down. And you're probably thinking to yourself, well, the Fed's going to start raising rates, then bond yields are going to go up. If the Fed is indeed behind the curve by a lot, it means that the bond market has already priced in those 7 rate hikes for 2022, and that the current yield is already 90% or 95% of the way towards where they see it at the end of this 7 rate hike cycle. And so if the Fed doesn't do 7 rate hikes, that means the bond yields are right now too high. So if you think about that in that context, I think it's really important to remember the United States pays 1.9% for a 10-year bond. And then Google all the other countries, all the other developed countries, and what they pay for a 10-year bond. If you can find one that has a remotely close to a robust economy as the United States has, and pays anywhere near the 1.9 yield, you'll see that this is the anomaly. This is the bargain. This is the highest yield you're ever going to get from a Western government. And so I think that there's a lot of pressure, there's a lot of buying pressure on the 10-year bond, and that will compress the yield back down. To your question, I think right now you are in a situation where bond yields will stay elevated. The S&P 500 dividend yields will be lower than the 10-year bond. That will continue to be a problem for the large indices. And I think when that starts to correct is when bond yields start to go back down, and companies report better earnings and raise dividends, and that's going to cause the S&P 500's dividend yield to go up. But it doesn't necessarily mean that they're going to revert again to where the dividend yield of the S&P 500 is going to be higher than the bond yield necessarily in 2022. And that's not a reason not to buy stocks, because like I said, this game of who has a higher yield, that's a game for institutional money. So for sovereign wealth funds, for algorithms, that's not for you or me. If you ask me today, do I want to lend Washington money 1.9%, or do I want to buy the S&P 500 with its 1.3% yield, but it has a 6% growth yield for the entire index, plus most of the S&P 500 companies buy back stock, and their EPS is growing. I mean, it's obviously a no-brainer for me what I want to do with my money for the next 10 years. So this is not for you to think about. This is for obviously large money. Now, when big money prefers stocks, that's going to help all of us. But what it means is basically this is a buying opportunity for the little guy, for when later on when institutional money pivots back to stocks, it's going to help you in all of your market-related positions.
Got it. All right. So I'm watching small caps, mid caps. I'm watching gold, silver for those levels that you mentioned. 25 and silver will be coming soon, I think, and much higher, of course, and gold as well. Gold just broke 1900, on the way to much higher prices, in my humble opinion. Mr. Lior Gantz from wealthresearchgroup.com. Everybody needs to go over there, and I'll put a link in the description below this video. Sign up for the newsletter, get those 2 reports. Also on your screen right now, so you can see what they are. Easier just to click on that link. Go there right now. Thank you, Mr. Gantz, for your excellent insight as always. We'll have to have you back here when gold and silver are much higher. Thank you, sir.
Thank you, David.